Let's take a look at the 10K and the 100K premium selling portfolios today. I have some interesting things to show. So today the market is up and volatility is down, as you would expect. Market's rallying. It's the second day in a row that we've seen the volatility come in, so this is a good trend. And as you would expect, premium selling portfolios are going to do well today. And I'm up in my $100,000 account. I'm up about $1,000, and my 10K account, I'm actually down 59 bucks today. Overall, I'm up, but there's one thing that happened today that I'm going to demonstrate here and show you what will happen. If you sell premium enough, I've been doing this long enough where I know this will happen every time, and you're going to have to either make a decision on what kind of risk you want to continue to take on a naked position, adjust it, close it out, or do nothing. So what I want to show is that with BABA, you can see here today it's down 90 bucks. Everything else is up. Facebook's up, Fit is up, and the reason why is because BABA is up 9.5% today. That's a big move. I'm not sure what the news is. Alibaba gets a deal and Groupon gets a lift. Check the news real quick actually. Okay, so it appears to be some kind of news on Alibaba and Groupon. I'm not going to bother to look at that now, but either way it's fine. It's up 10% almost. So I have a naked position. I have a 70 call. The stock's at 66, and I need to decide whether it's still got about 5% to move, but I need to decide whether it's worth the risk for me to either just leave it alone or I can adjust it. Now, I will say leaving it alone is actually a really valid strategy. And if I look back in the past, probably more than 50% of the time, if I would have just left things alone, it probably would have worked out fine. And I have a tendency to almost never leave things alone because it's just, as a trader, my style is I just need to feel comfortable with the position at all times. And I never like to be in a position where my position is just going against me in a way that feels uncomfortable. So this is just my style of how I trade, and I prefer this way, but it's really up to you to decide how you want to trade these. But I mean, you can still do nothing, right? Because like I said, at BABA at 66, it still has a chance to stay under 70, right? It can still expire. If it were to expire, stop here, it would expire worthless, and I'll make my full credit. But after a 9% move, you might assume that the trend will continue, and it could breach 70 pretty easily. So this is what I'm going to do, and I'm going to show you really quick how I use tools in my broker. Right now, TraderMob doesn't have advanced tools for options analysis because that's just not our specialty. We're not spending time and resources to do that yet. We may in the future, but for now, we don't have the advanced tools that you would get at a broker like Thinkorswim. So when I go to my broker, I look at my, I pull up. So Bob is on a good move today. It's still moving up. So I go to my analysis, and what I do is I pull up my trade in my analysis tool in Thinkorswim, and this is my actual trade on TraderMob right here. This trade here is the risk analysis for that trade. So here's my strangle as it stands right here. My strangle today with BABA, the risk profile looks like this. BABA's at 66, and you can see that this line here is BABA at 66, and this line here is 5% out of the money at 70. So if BABA moves past 5%, this position will start to lose money pretty fast. And that's what happens when in a naked strangle, is that once you breach the strike on one end, if there's time left, the position will lose value really fast. And you kind of want to avoid those situations. Like I said, you can leave it alone because there's still 5% move, and Baba can just wiggle around here and come back down a little, and you might get the full credit here. But it's just not my style, and so I like to be I like to feel comfortable in a way that the position looks good at that moment. So what I'm going to do here is the easiest way to adjust this position is when I look at it, I think to myself, so right now my delta is at -31, and that's what you would expect if it moves towards the strike. If it moved towards the put strike, and Baba was at 53, I would have a positive delta because the bias would be that I would want the stock to go back to move up, because the puts have gained so much value that it became a positive delta trade. And since strangles are neutral, you normally want to stay relatively neutral. And so in this case, my delta is -31. And so what can I do quickly? For me, there's a couple ways. There's only one way that I like to adjust these. You can do a couple things. You can roll the put up. I can sell this 50 put because the 50 put right now is worth 34 cents. The call is worth almost $2, right? So at 30 cents, what I could do is I could actually sell. I can close the put and then roll it up to like 55 and get another bigger credit. So I can add more. So the deltas will be neutralized, and then I can add more protection to the upside. But the problem with that is that if the market were to just reverse like tomorrow, and we're in a shaky market right now, right? So I'm a little wary on just kind of thinking that volatility is already, out of the markets. I'm not convinced yet. So we could turn around this week and things could get really crazy. And if I sell a put, let's say I sold a put and rolled it up here, I closed my put and sold another one at 55, and all of a sudden Baba reverses tomorrow and volatility skyrockets. All of a sudden I'm losing on both sides of the trade, and now it's a big loser now because I'm losing on my puts. So I don't really like that trade for this case in this scenario. Another scenario I might like it, but for this scenario with where the markets are right now, I don't really like that trade. So I could quickly neutralize my deltas by buying stock, and if I buy stock, look what happens to the risk graph. So you can see here I click this stock, 50 shares. You can see when I add 50 shares, and this is the cool part about this tool, is if I add 50 shares right here, I check it, you can watch my deltas go from -31 to +18. And now what happens is, as Baba goes up, if it goes up slowly from here, which is what I'm going to want it to do, I can make money, a decent amount of money, all the way up to 70, because my stock will make money from here to 70, and my short calls will continue to lose value and decay, and I have a chance to make money anywhere in this big, this tent here, this area from 78 to 139. So now I can change my position in a way where the stock can continue to go up, and I can still make money, even more money, because I'll have stock on the trade if it goes up all the way to 70 in the 70s. So that's another 10% move. I can still profit on this trade. Whereas if I didn't do this, a 10% move, I'll start to lose money. So buying stock is a very quick way to neutralize your deltas and not expose yourself to more kind of vega risk or theta decay, right? Some people might say buy calls, right? Buy calls would be the worst thing to do, because once you buy calls, it wouldn't be the worst thing to do, but it's just not the best thing to do, because buying calls then your theta, buying calls is a negative theta position, so you could actually lose money if the stock continues to go up slowly. So it's not a really good hedge, because you could lose money still if Baba decides to go nowhere. With stock, I won't lose money if Baba goes nowhere. And if Baba goes down, let's say Baba reverses here, yeah, I'll lose money on the stock, but it's stock, so I can hold it for as long as I want. It doesn't have an expiration date, right? So with Baba as a company, from another, if I look at this from another perspective, Baba is not a company that I think is going to go to zero, right? I don't have a lot of, I don't think there's a chance that Baba will come out with some horrible news about. I mean, it's a chance, but it's not. But it's an established company. It's a huge company. It's like the Amazon, you know. So I have confidence in holding stock that it doesn't really. I don't lose sleep at night holding stock in Baba. So buying this stock is a good way to quickly change these deltas to positive, and now I can make money if Baba continues to go up on a slow trend. And it's still going up now, so let me go ahead and do this trade. So on Trader I can go ahead and buy. So I have 50 shares here. So I go Baba, I can buy 50 shares, 3,000 worth. So the reason is because buying stock to add positive deltas to my short strangle, which is going against me at the moment. Baba has jumped 10% today, bringing the short 70 call strike in danger of being breached. So that's basically my whole reason and description in a nutshell. The 70 call is being in danger of being breached. You don't want your strike to be breached in a naked strangle, because that's as soon as it breaches that point, and if there's time value left, the trade will start to lose money pretty fast. So let's place this. Cool. So now I have a trade where I have stock in Baba, and then a long and a short call, and a short put. So now I hope, and what I'm going to do here is, this is kind of cool, is what I'll do here is just so I can keep track of, so I can use this as reference as a trade journal. I'm going to show you an example of how you might use TraderMob to kind of track your thoughts and your process along the way during the lifetime of a trade. So now I'm going to take this image, this risk graph here, and I'm going to take a snapshot. Let's see, I haven't done this in a while actually. What is that? Where is that? Oh, take screenshot. Duh. Okay. Alright, so what I'm going to do is I'm going to save this risk graph and analyze. And what I'm going to do now in my Baba trade, I'm going to go to the trade page, and I'm going to add a photo. So if I choose a file here, and I pick so now I just attach the image, and please add comment for your attachment to complete the post. So now I can just say, here's the new risk profile of Baba after adding stock to the short strangle to neutralize deltas a bit. Now the trade is a positive biased trade. Submit. There. So now on my trade page I have this. I bought the stock just a few minutes ago, and I've attached the risk graph. So this trade page now has my activity of everything I did over the lifetime of this trade, and I can look back at it and see exactly what I did right or wrong, and learn from it and use it as reference. And now this picture, oh, that's an ugly looking risk graph. The image is kind of screwed up. But you can see now that it's got the risk graph here. It shows you that what I was just showing you earlier, and my break-even points, and the level of where my biggest profit is at expiration. So you can see here by the peak, this peak of the triangle here. Ideally, I want BABA to be right at 70 at expiration. That would be the best case scenario. BABA's at 70 at expiration. The calls expire worthless. The puts expire worthless. My stock has gained 5%, and I make $400 on the trade instead of 200, which was the maximum amount of money that I could have made with the sold puts and calls. So this will be an interesting trade, and let's see how it works out. And we'll come back and revisit it, and we'll show you exactly how it worked out at the end of the trade when I close it, whether it made money or lost money. And then we'll also see if this adjustment turns out to be a good one or not. And I'll get to look back and say, well, I did the right thing, or I did the wrong thing, and I'll get to learn from this process, and I get to always have this reference to look at in the future when I want to look at how I did in the past with my naked strangles. And real quick on my 100K portfolio, I want to really quickly show you that something interesting with Facebook. If you look at Facebook, Facebook is down about 1% today, and I'm up $140 with stock. So I have stock right here, but the reason why I'm up still is because my strangles. You can see here, Facebook, even though it's down 1%, the put is making money because of the premiums coming in and theta decay. Theta plus premiums coming in, makes these profitable. So that's why in a market rally, if you follow the VIX, you'll see that every time the market rallies, the VIX volatility almost always comes down. Almost always. So that correlation is very strong. So anytime the market rallies, I expect my premiums to come in and my short calls to come in. So when the stock goes up, even though the stock goes up and I have a short call, that's probably not going to lose as much as the short put. So here's an example. Amazon has a negative delta of 22. Stock is up 2%, and I'm up actually, so I'm flat today. But you can see the put is almost as much, and a 2% move is pretty big, so the call is losing almost as much as the put is making, even on a big move. So you can see how premiums are. It's hard to fight the loss of premium in a short put or call. So if you can to have the stock over the direction, it's hard to have the direction overcome the loss of premium in calls and puts. That's the most important thing to remember. If the stock moves up and you have long calls and premium falls, it's hard to overcome that loss in premium with the gain that you made in those calls. So that's a lesson I learned earlier in my trading career. But all right, so good day for premium sellers again, and we're going to check back on this trade, the BABA trade, because this is an interesting trade that that you will have to deal with if you sell naked options. It's going to a naked strangle will go against you at some point, and you're going to have to deal with either the decision of making an adjustment or leaving it alone or closing it out and cutting your losses. I prefer not to close out and cut losses. I prefer to adjust, and we'll see how this works.